Okay, so you want to buy an oil tanker. Not a small one, a VLCC, a very large crude carrier. The kind that moves 2 million barrels of crude oil in a single trip. The kind that, in March 2026, during a crisis in the Strait of Hormuz, earned $445,000 a day on a single route. Let that number sit for a second. $445,000 per day from one ship on one route. That is more than most hedge funds return on a full position in a year, and you would own the asset generating it. So here's the question nobody in the shipping press seems to ask. Why do tanker owners keep going bankrupt? There is a number, not the $445,000 one, a different number, that determines whether this business survives. We will get to it. But first, you need to understand what you are actually buying. A 5-year-old VLCC in today's market runs about $114 million. That is the price of entry. At $445,000 a day, the math looks staggering. $162 million in gross revenue per year if the rate held. More than you paid for the ship in 13 months. Clean profit from there, except the rate didn't hold. Before that March 2026 spike, the same class of vessel was averaging $40,000 a day. Before that, during the seasonal trough of August 2024, the average rate across the global VLCC fleet was $29,800 a day. The same ships, the same routes, the same ocean. The $445,000 a day was real. It lasted weeks, and then it was gone. Here's the number nobody tells you about, $37,700 a day. That is the cash break-even on a financed VLCC. Not the rate you need to profit, not the rate you need to pay yourself, the rate you need just to not fall behind. Crew, insurance, maintenance, debt service, all of it. And it runs whether you have a cargo or not. Start with what never stops. A VLCC needs around 25 people at sea at all times. It needs insurance on a $114 million asset. It needs maintenance reserves, lubricants, stores. Before a single barrel of oil moves, keeping the ship alive costs $8,000 to $10,000 a day. Every day. Whether you are loaded, anchored, or waiting for a call that isn't coming. That is the floor. Then you add financing. Most buyers don't pay $114 million in cash. Owners typically borrow 65% of the purchase price. Stack the debt service on top of operating costs and your cash break-even lands at $37,700 a day. Every day, the market pays below that number. You are not losing profit. You are burning capital. In August 2024, the average VLCC spot rate was $29,800 a day. That means the typical tanker owner, in a completely normal seasonal market, was losing $7,900 a day. Every day. For weeks. The ship was fully operational. Nothing had gone wrong. The market just wasn't there. 90 days at that loss rate. $711,000 in the hole. Before debt. Before anything unexpected. And something unexpected is always coming. Every 5 years, every VLCC must enter dry dock for a mandatory special survey. The ship goes dark. No commercial service for 60 to 90 days. Zero revenue. The $8, $000 to $10, 000 a day clock doesn't pause while the ship is in the yard. Add yard fees on top. Add compliance upgrades. Since 2024, most VLCCs built before 2019 have needed ballast water treatment systems installed before their next cycle. Each one, millions. And then there is fuel. Underway, your ship burns 600 to 700 barrels of its own fuel every day. On a 45-day round trip from the Persian Gulf to China, that is up to 31,500 barrels of bunker fuel coming out of your pocket, not the charterers, at least on spot voyages. Here is what all of that adds up to. A VLCC sitting at anchor costs more per day to keep alive than the average American household earns in 4 months. Empty, not moving, still billing. That $445,000 a day? It lasted about 11 weeks during the COVID storage boom of 2020. Then the market moved. Average rates spent the next 18 months below break-even on a financed vessel. Same ships, same fixed costs, different math entirely. Here is what makes this business unlike any other asset class, the swing. In March 2020, as COVID destroyed roughly a quarter of normal global oil demand, VLCC rates hit $264,000 a day, the highest level since 2008. In March 2026, during the Hormuz crisis, rates reached $445,200 a day on the benchmark route. A broker's report at the time described it as rates that were never, ever before. In between, August averages as low as $8,500 a day. That is the 20-year seasonal baseline. Same ship, same ocean. $8,500 one August, $445,200 during a crisis. A 52 times swing from the same physical object doing the same job. No airline, no hotel chain, no real estate sector produces that kind of variance on the same asset. It gets sharper when you zoom in. In November 2025, VLCC rates peaked above $118,000 a day. 6 weeks later, in January 2026, the same vessels were earning just under $40,000 a day. A 66% drop. No change in the ship, no change in the crew, no change in the route, just the market. Why? Because tanker supply is structurally frozen in the short term. A new VLCC takes 2 to 3 years to build. In 2023, the major shipyards in China, South Korea, and Japan were fully booked with container ships and LNG carriers. The VLCC order book to fleet ratio, 1.9%, one of the smallest in history. Almost nothing coming. So when demand ticks up by even 1%, a geopolitical rerouting, a floating storage play, an OPEC shift, supply cannot respond, not for years. Rates go parabolic. When demand drops 1%, the same math runs in reverse. A 1% surplus crashes rates 30% to 40% in weeks. You cannot add a ship fast enough to catch the upside. You cannot exit fast enough to escape the downside. You are in $74 million in debt, and the market moves on its own schedule. In a good cycle, one ship generates more free cash flow in a single quarter than it earned in the previous 3 years combined. Owners who had vessels in position during the 2022 Russia rerouting, the 2023 Red Sea disruptions, the 2026 Hormuz spike, they made extraordinary money. The upside is real. This is not a bad business. The problem is nobody controls the timing. There is a player in this market who made $5.3 billion in a single year from this exact pendulum. They didn't own a VLCC when the year started. Let me show you how that works. April 2020. Oil demand has just collapsed. US futures briefly went negative. Producers were paying buyers to take their crude because there was nowhere left to store it. The market was breaking. That month, Trafigura expanded its tanker fleet by 70%, not to own ships, to use them. Trafigura is a commodity trading house, one of the largest in the world and almost entirely unknown outside the energy industry. It doesn't sell gasoline at the corner. It moves crude oil and commodities across the global supply chain. When COVID hit, Trafigura saw the structure of the market shifting before most others did. Here is what they saw. When oil demand collapsed, the crude market moved into contango, a structure where futures prices are higher than today's spot price. A barrel you can buy right now is cheaper than a barrel you can sell for delivery 6 months from now. In April 2020, that spread hit $14.46 per barrel, a record. Here's what they did. They bought crude at spot. Simultaneously, they sold forward contracts at the higher futures price. Then they needed somewhere to hold the oil while they waited for the delivery date. They called the ship owners. A full VLCC cargo, roughly 2 million barrels. At a $14.46 spread, the potential profit locked in on a single cargo was around $28.9 million before costs. The ship owner charged $200,000 a day for 90 days of floating storage. That's $18 million in freight. Trafigura paid it without hesitation. The contango spread was worth nearly $11 million more. You own the ship. You collect the $18 million. You think you won. Trafigura collected $28.9 million from the cargo sitting on your ship, and they carried none of your costs to get there. No $114 million on their books, no break-even clock, no dry dock schedule, no CII compliance exposure. Trafigura's gross profit from oil trading that fiscal year, $5.3 billion, 3 times the prior year. The CEO described April 2020 as the busiest month in the company's 27-year history. Vitol Group, the world's largest independent oil trader, roughly 600 employees, London, doesn't publish its results publicly, but accounts that have surfaced show $15.1 billion net profit in 2022, $13 billion in 2023, $8.7 billion in 2024. 3 years, $37 billion net. Vitol does not own a significant VLCC fleet. It charters vessels when a spread makes the freight worth paying. The structure is always the same. The commodity trader uses the ship as a financial instrument. The ship owner provides the infrastructure and absorbs everything that comes with it. The $114 million capital, the $37.700 a day clock, the 20-year depreciation curve, the dry dock, the regulation. The trader takes the spread from the cargo. The owner takes the freight. One of those is the business. The other is the cost of doing the business. Most tanker owners don't fully see this asymmetry until they look back. There is a way to protect yourself from the worst of it: a time charter, a fixed rate that smooths the volatility. But every time charter has a ceiling, and that ceiling tends to sit just below the exact rate that makes the ship worth owning in the first place. 3 people entered this market at different moments. Same vessel type, very different outcomes. The first owner signed a 3-year time charter in mid-2024 at $53,000 a day. Scrubber fitted, eco-rated, locked in at a fixed rate. He missed the $200,000 days. He will never see $445,000 a day on his vessel. The spot market captured those spikes. He did not. But when spot rates averaged $29,800 a day in August 2024, below break-even for any finance buyer, he collected $53,000 every single day. While spot operators ran negative, he ran $15,300 above his break-even of $37,700. 3 years of that math, roughly $16.7 million in net operating income. Stable, predictable, nothing to write home about, nothing to restructure either. The second owner bought a VLCC in late 2022 near market peak at $130 million. The upside looked too good to lock in a fixed rate, so he played spot. He caught 8 weeks of strong rates in 2023. Then August 2024 arrived. Spot rates, $29,800 a day. His break-even, north of $38,000. He was losing $8,200 every day. Then his dry dock came due. 75 days off hire, operating costs still running, $750,000 in costs against zero revenue. Regulations required a ballast water treatment system before the next cycle. Millions more out of pocket. His vessel is now rated D on the IMO Carbon Intensity Index. 2 consecutive D ratings require a corrective action plan with the flag state before the next voyage. Major oil companies have CII performance clauses written into their charter agreements. His charterability is impaired. He is currently in restructuring conversations with his lenders. The upside was real. The asset is illiquid. There is no exit that doesn't hurt. The third player never bought a ship. When the Hormuz crisis hit in 2026, a trading house chartered a VLCC at $445,000 a day for 14 days to reroute a cargo already sold forward. Total freight cost, roughly $6.2 million. The cargo spread covered the freight and left margin. Capital deployed for 2 weeks. No dry dock exposure. No CII risk. No $114 million on the balance sheet. Trafigura made $5.3 billion in 2020 using ships they didn't own. Vitol made $37 billion over 3 years doing the same across energy markets. Neither company needed to own the asset to extract its value. Same market, same volatility. 3 completely different experiences. The first owner understood what he was actually managing. Not a bet on rates, but a liability that needed hedging. The second owner thought he was buying the market's upside. What he actually bought was full downside exposure, with a 2-year lag on any exit. The third player understood that the ship was infrastructure. Not the trade, but the cost of accessing the trade. A tanker doesn't earn money, it absorbs risk. The people who got rich in this industry figured that out and got off the ship. If you inherited a VLCC tomorrow, time charter or spot, drop your answer below. If you want to understand what things actually cost to own, subscribe. We'll keep going.